big banks are noticing the shifting tides in the economy. Take a look at this article from Financial Times. It says the largest U.S. banks are set to report their biggest jump in loan losses since the onset of the COVID-19 pandemic. The banks, JP Morgan Chase Bank, Bank of America, Citigroup, Wells Fargo, Goldman Sachs, and Morgan Stanley will set aside an estimated $7.6 billion to cover loans that could go bad, according to analyst forecasts compiled by Bloomberg. These are some of the biggest banks in the world. And you have to remember that when they're putting these billions of dollars aside, that's money that they cannot use to generate revenue. Because the way that banks make money is that they lend money out. And when they lend money out, they generate interest back. And so if they're not lending money out, they're not getting any interest back, which means less revenues. So if a bank is not going to be putting money out, there has to be a reason why. And the reason why here is because they're worried about loans defaulting. So they want to have money to protect them against the loan losses. This is where you're probably wondering, everything looks like it's booming in the economy. Why are banks putting money aside to protect them against these loan losses? Well, because of two things. Number one, because of the stalled impacts of higher interest rates. And number two, because of slowing consumer spending. We've seen interest rates rise pretty significantly over the last couple of years, and we have yet to see the full impact of these higher interest rates, and banks are thinking that these higher interest rates are going to cause some commercial landlords, some business owners to default because they're not going to be able to continue making their payments. And then number two is consumer spending is slowing down. Now, consumer spending is one of the main drivers of our economy because our economy runs on spending. When you make money, and you go to Chipotle, you go to Lululemon, you go to Sweetgreen, and you spend money and you buy the extra guac, well, guess what? These companies are making more money because you're spending money there. And if you don't spend your money there, maybe because you lost your job, maybe because you want to save your money, or maybe because the cost of living for your rent and your car and your gas and your groceries are so much more expensive that you have to stop going out and shopping. Well, if that money stays in your pocket or it stays in your bank account, if you don't have that money, that means Lululemon, Chipotle, Sweetgreen stop making money. And if they stop making money, they're not going to be able to continue expanding and hiring more employees. In fact, they might even have to downsize. They might have to shut down some stores. They might have to lay off some employees because they stop making money. That's why we live in a consumer-driven society where the more people spend, the more businesses make. In fact, our entire economic system is built around this. We live not just in a consumer-driven society, but we live in a credit-based society where consumers, regular people, have the ability to spend not just based off of how much money you have in your bank account, because that would be boring, but based off of how much credit you can qualify for. You might only have $100 in the bank, but you might have a $1,000 line of credit with your credit card, which means you don't just have the ability to spend $100, you can spend $1,100. What does that mean for the economy? That allows the economy to boom in the short term because now you have way more spending ability. More spending ability means more purchasing power, which means more boom and growth in the economy and businesses. And that's what we've been seeing happen. We've been seeing the economy grow, incomes rise, credit worthiness also rise, spending boom, especially for the last few years. We've seen incomes rise, and there's more jobs than really ever right now, which means everybody has a job who wants one. Maybe it's not the job that you want, but everybody has a job who wants one. And the reason why there are so many jobs out there is also because of, well, partially due to all the money that was created in 2020 and 2021. When you give businesses billions and billions of dollars, what are they going to do? They're going to create more jobs, open more stores, open more research and development plants, open more factories. That way, they can continue producing their stuff because they're going to want to make a return on their money. And so we have all this excess money that was given to businesses that created all these jobs. But so we have all these jobs that are created. Maybe it's not the job that you want, but people who want a job can get a job. People have incomes. Incomes have risen in the last few years. Maybe it hasn't risen as fast as inflation, but they have definitely risen in the past few years. And then because incomes have risen, credit worthiness has also risen. So banks, credit cards are looking at people's incomes and saying, you're making more money? How about another home equity line of credit? How about another credit card? How about a bigger line of credit on your credit card? So what does that do? More spending ability. Well, that's what's been happening. But now, in the second half of 2023, we're starting to see a shift. Now, that shift initially was kind of triggered by the higher interest rates. But now we're starting to see a shift because consumer spending is starting to cool down. And the reason why consumer spending is starting to cool down is because the prices of everything have risen so fast. We've had so much demand from all the inflation that has happened, right? There was so much money created. People wanted to buy things, and people were willing to pay the higher prices for things because they had the ability to do so, and people just kept buying. Now, this doesn't mean that people had the ability in their bank account, but they had the ability through debt. And now what we're seeing happen is that people have been spending so much that they're having to dig into their savings to continue spending, not just to buy big lavish things, but to make their regular purchases. In addition to that, people are digging deeper and deeper into their credit cards to continue living their lifestyles, because we've seen all this inflation, and now people are starting to see this kind of imbalance in their finances. This is kind of, I'm speaking in generalities, but we're kind of seeing this happen where more and more Americans are saying, my income is no longer enough to continue funding my lifestyle. So what do? Do I cut back on my lifestyle, or do I go into debt and dig into my savings to continue funding my lifestyle? And statistically, what we're seeing happen is more and more Americans are saying, all right, yeah, let's just dig into our savings and let's go into credit card debt to continue funding this lifestyle. That's why we're seeing now savings balances get reduced and we're seeing credit card balances skyrocket. Eventually, this is going to hit a breaking point. This is one of the reasons why now we're seeing consumer spending slow, because eventually people are going to get tapped out on how much debt they can spend. And people eventually are going to tap out of their excess savings. In fact, there's a pretty big consensus amongst big banks that by the end of 2023, that the vast majority of people's excess ability to spend is going to be gone. Goldman Sachs says that by the end of 2023, 65% of this excess money and spending ability is going to be gone. Now, what does that mean? If people's spending power goes down, that's going to hurt the economy's growth potential. Now, we did a full deep dive of this in market briefs, but this is so important for you to understand because consumers are what drive the economy. And if consumers cannot continue spending or continue growing spending or continue funding the higher prices of things, that can cause a break in the economy, which would cause then a domino effect. Now, if you have not joined Market Briefs yet, it is my free newsletter that I created to keep you up to date on what's happening in things like the housing market, the stock market, the general economy. That way you don't get blindsided by what's happening in the economy. It's completely free to read. It's super easy to read, and it's going to keep you updated on what's happening in less than 5 minutes every morning. So if you have not joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market, and I also got the link for you down in the description below. But let me add one more variable into this, because now not only are people's incomes not rising fast enough with the cost of livings, people are digging into their savings, credit card debt is rising, but then this October 2023, student loan payments are restarting, which means we have millions and millions of Americans who have not made a single student loan payment since before the pandemic, have completely forgotten about their student loans, who are going to be hit with an additional $450 a month charge, maybe more, maybe a little bit less, depending on how much you owe. But let's just say $450 a month because that's around the average student loan monthly payment. Now what? We're hitting a time, inflation is still high, the prices of things are rising. People are digging into their savings, people are digging into their credit card debts, and then people get slapped with an additional student loan payment. And if you're not prepared for that, which I'm going to give you a little bit of advice on this, start preparing for your student loans before your student loans start. That means start putting money aside while you still have the 0% interest rate. That way you can aggressively attack your student loans, because if you can pay down your student loan balance before the interest rate starts, you're going to have less money to actually pay back and less interest that's going to be charged to you. So start preparing before the student loans actually start. Be aggressive about it, because you have this opportunity right now between now and the beginning of student loan payments to start paying down your loans. That way you have less balance left over. So start preparing today. Pretend like the student loan payments have already started and start putting money aside for that. But all these things are going to play a factor. And so now you start calculating, what does all this mean? Spending is starting to slow. Credit card debt is rising. Savings levels are dropping. Student loan debts are about to restart. These things are going to play a factor in the economy, all while we're also seeing higher interest rates. In fact, interest rates could potentially and should go higher, because we're still seeing the impacts of the high inflation. And so now if we continue to see higher interest rates, that makes borrowing money more expensive. It makes your credit card debt more expensive. It makes buying a home more expensive. And that also hurts businesses. It hurts businesses because businesses don't have 30-year fixed rate mortgages. Businesses have adjustable rate mortgages. And so now if businesses see a slowdown in their revenues, they see a slowdown in their profits, they could also see a rise in their expenses, not just because of inflation, but because their debt payments have gone up. Why? Because their debt servicing costs have gone up because interest rates are higher. Same with commercial landlords. If you own office space, which again does not have 30-year fixed rate payments, your payments will readjust. And if they readjust at significantly higher interest rates than when you initially got them, that could pose much higher expenses for you as a landlord. So you can start to see how in the coming 18 to 24 months, we're going to see a lot of shifts in the economy. And this is where your job is to, number one, monitor all these things. That's what we cover in market briefs every single day. But then number two, understand this. That way you can start preparing. The way you prepare is by getting financially smart right now and by putting money aside. Getting financially smart means learning how to invest, learning what is a good investment, how do you capitalize on opportunities, what's stock market investing, what's real estate investing, but then also being prepared, meaning have cash aside to protect you against an emergency, but then also have cash aside to be able to capitalize on opportunities, because when you see these types of slowdowns, that also creates opportunities for people who have access to cash. And it's kind of like a cherry on top, especially for those of you that are still watching this video. The Federal Reserve Bank also wants to increase unemployment because that's one of the factors that they're looking at when it comes to inflation. The Federal Reserve Bank wants to cool down inflation, and one of the impacts of cooling down inflation is higher unemployment. That's why you keep hearing the Federal Reserve Bank saying that the labor market is too tight. There are too many jobs out there. So the Federal Reserve Bank wants to cool that down, meaning raise unemployment, which then trickles down to every other part of the video that I was talking about, because if unemployment levels go up, less people have jobs, less people have incomes, that means less people are credit worthy, and less people have spending ability. If less people have spending ability, less money is going into certain businesses. If businesses are making less money, that means their revenues are falling at a times where expenses could also be rising. Why would expenses be rising? Well, number one, inflation, but then number two, because debt servicing costs are rising. So these things are going to be playing out in the coming couple of years, which is why you need to be the one that's getting prepared and financially educated. There's been a lot of talk recently about the real and root cause of inflation, where you've had a lot of media articles saying that corporate greed, it's what's causing inflation, and it's the reason why inflation is still here, and it's the reason why inflation is not going down. That corporate greed, wanting to maximize their profits, is why we are seeing